We'll touch on the big, beautiful bill. Lots of discussions here. I know the investment team talked about how that has the impacts on the overall economy, the U.S. debt limits. We're going to tie that to kind of what that means for personal wealth planning as well.
Perfect.
The One Beautiful Bill Act that just passed the House and is going through the Senate right now. Keep in mind some of the things we're going to talk about here today, are subject to change. Let alone they will change, just based on how everything gets scrutinized and beat up through the bill process itself. But we thought I'd take a few minutes and just highlight some of the big features that are coming through that would be relatable to your personal financial wealth, your planning, and making sure that you're thinking about this as this progresses through Washington. Certainly, we'll be reporting back as things become solidified. But these are a handful of things that we're watching closely. We'll be reporting to our clients. All right. So let's jump into the next slide as we think about this big, beautiful bill. So as we take a look at what's being proposed out there, we've built this out. To the left-hand side shows what's being proposed as more permanent measures, which these are things that are already in place that would continue on, but then also what might impact you from a temporary standpoint. Those are on the right-hand side. So why don't we first focus on the permanent measures, Mike?
Yeah, so I'd say the biggest one that's going to impact all individuals and families we work with are the tax brackets. I guess the good news is that there's not projected to be any significant changes to the current tax brackets that have been in place since 2017. So the current tax brackets that you've been filing for the last 7-8 years are projected to be made permanent indefinitely going forward. As we mentioned, all of this can change, but as of the first version in the House, today's tax brackets would be made permanent.
Yeah, I'll hit on the mortgage interest. This is the one that in 2017 was reduced to $750,000 in total debt. The interest on that can be deductible, so that's capped on the balance there. Previously, that was $1 million, so that's looking to be locked in at $750,000.
Everybody's favorite table seasoning, or state and local income tax deduction, as we like to know it. So the current proposal is that the state and local income tax deduction would increase. That would be from $10,000 to $40,000. It appears that is going to get beat up a little bit in the Senate. That 40 might become 30. I think that's definitely a TBD measure, but It appears there is some momentum and advocacy for at least increasing that state and local income tax for certain, or for all Americans, but we know that's going to impact clients in California, New York, Illinois, et cetera.
I think this is a big one to watch, just based on that was a big takeaway, especially with everyone's real estate taxes. You're hitting that $10,000 cap really fast. But tied to that is the overall standard deduction, because that was a big impact in 2017 where that doubled, which also ties to if you itemize or you don't. So again, this one's going to be very important to watch to see if it gets solidified, because this will also drive a lot of the charitable donation strategies that we help clients out with, and just thinking about how do you best optimize the activities around your giving strategy if you're itemizing or not.
The next one is we look at lifetime giving and federal estate tax. There had actually been some thought, and we've had conversations the previous years, that limit was going to get cut in half if the current Tax Cut Job Act was phasing out. It appears now the current federal gifting and estate tax limits that we have today are likely to be made permanent. So more or less some more breathing room for those taxable estates. General numbers, if you're single, about 15 million and above, or if you're a couple, about 30 million and above, those limits will remain in place today and be made permanent.
Yeah.
There is a current child tax credit in place, about $2,000. There will be a temporary increase proposed for about $500 additional through 2028, and then after 2028, it will reset to the current limit and be tied to some inflation adjustment. But overall, for families who are claiming that child tax credit, that is also expected to be made permanent.
So as we think about the temporary side of things, looking to have those extended and potentially retroactive to even this year, no tax on tips or even overtime, potential even deduction on car loan interest if that car was finalized here from a build standpoint in the United States, and as well as some additional senior tax deductions there. Not going to go too far in details, a lot to evolve there, but these are a couple things that we're watching that can definitely tie to your own personal planning and potential net tax rate as well. So as we look at like the wealth impacts, I think this is important because at the end of the day, we want to make sure, if you're thinking about how these different moves and levers you can pull can impact your wealth. I know we've hit on a few of these, and we think some of the big ones are going to be tax bracket, SALT, the estate piece.
Another one we're at least interested to learn more about is a potential expansion of HSA or health savings account. We do have a fair amount of individuals and families that have these today, and ultimately this proposed expansion of the HSAs would allow more health plans to qualify for HSA contributions. So currently, only if you're in a high deductible health plan are you able to contribute to the HSA. We have a lot of cost benefit conversations around if it makes sense for individuals today, but this expansion would allow maybe some more PPO or even lower deductible plans to qualify for the tax efficient savings in HSA. So we're excited about that. And it would also potentially make things easier for families doing catch-up contributions in HSAs. It would allow you to do the catch-up contributions into your shared account, where we've had a few individuals have to open up a separate HSA account just to make their annual catch-up contribution. And it's not the most administratively efficient right now. So that would be one thing to look forward to, hopefully, if that continues.
Yeah, I think that'd be a welcome change. I feel like all health plans are high deductible these days. And, that little nuance around the titling is a big driver of that. But certainly that's a big one. What about Trump accounts?
So there is a proposal in place right now for Trump accounts. What these Trump accounts would allow for individuals or families to do is save up to $5,000 a year post-tax for their children. So there's no tax advantages to saving in these Trump accounts up front, but what the intention is for, to kickstart child savings. And then at age 18, the child would be able to withdraw up to half the account for education, housing, etc. And at age 30, they would be able to withdraw the other 50%. So it feels a little bit like a 529 account without as much of the tax benefits. And one of the proposals in the first draft of the legislation is that if you had a kid from January 1st, 2025 through January 1st, 2028, the generous government would give you $1,000 to kickstart your Trump account. So $1,000 is $1,000, but we'll see what happens.
And I think the other thing to note there is that some benefits there around capital gains treatment, just based on the assets and what they're used for. So something to keep a close eye on. And the last thing we'll just hit on is Social Security. That was a big topic of conversation going into this tax bill, where there might be no tax on Social Security benefits. That has not been included. So I think that's important to know as you think about your planning. At least the way it's structured today, that 80% of your benefits are going to be taxable income, based on the current tax rate that you're in.
Yep. Okay. And I would say the very last thing with clean energy credits, I know the removal of the EV or electric vehicle credits has gotten a lot of news over the past few weeks, but also for clients thinking about either solar panels, insulation, even home energy efficiency improvements, heat pumps, new windows, etc. The expectation is that credit would be phased out by the end of 2025. So PSA, if you're a client thinking about one of those solar panels or home efficient projects, this would be the year to add that to your home improvement list and let Neil and I know about cash flow.
Well, as we always think about how we can help, it's a big part of what we do on behalf of our clients, and I think it's all about communication and making sure that, if you're thinking about any of these topics on a regular basis, reach out to us, but certainly we'll be talking about how this bill is evolving through the Senate and through the rest of Washington to make sure that it's tied to the impacts of your wealth and making sure we're thinking proactively around any of those changes that might be coming down the line here. So that concludes our topics here today. Certainly reach out to us with questions, and we'll see you next month. Thank you. Bye-bye.